Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. March corn made a significant low on January 12th. That January 12th was the report that came out, was in conjunction with the timeline that we're looking for a potential turn. And as we can see, the market has been moving up nicely from there. One of the techniques that we use is the arc swing technique, where we capture a move and we take circular arcs from that move going forward. We can see that each time this market has come very close to one of these arc swings, that the market has made a nice potential turn from those movements. The next arc swing that we're looking at suggests that the current top that we're seeing now could be significant for this market, and we're looking for somewhere between the end of this week and perhaps as early as sometime next week as a potential time factor where this up move that we've seen can terminate and the market can then start to make its way back down again. Our cycles for now suggest that the market should be making a top somewhere close to the beginning of February, and for about 2 or 3 weeks from there, the market can make a final decline, and depending on where this decline terminates, whether it is a partial portion of this advance that we've seen, could make for the next leg of this market on the way back up. So what we'd be looking for now is between now and early February for the market to make a potential top, and in doing so to make a nice decline into about February 21st or 22nd, and from there to get one more move to the upside that can potentially test the current highs and perhaps make its way to about 365 to 370. Volatility-based resistance is now forming between 358 and 361.5, and we also have an N band that was recently formed just above the market. In doing so, we anticipate that at the very least we could see a bit of a sideways congestion and the potential for the market to actually start to turn down from here. And once again, we have our February 8th timeline as a potential topping formation sometime next week for this market. From here, then again, we'd look for the market to decline. We can see how very nicely the market found support at our 360-degree mark at 347.5. And we expect to see similar in terms of formation on the May contract as well. We can see here where the May contract found very good support near 353, and now we're looking at potential resistance overhead at about 370, and again with the same timeline of February 8th coming in sometime at the end of this week and perhaps sometime early next week. The angle of 270 overhead lands at 370 for the May contract, and again we can see volatility-based resistance forming overhead. In a similar fashion, an N-band did form, although for the May contract it occurred a couple days ago, a little bit earlier than what occurred for the March contract. March beans made its way up to the $10 mark, and to no surprise, after reaching that $10 area, the market has found a bit of weakness or some softness from there. The market had made a very big decline previously, came in and made a very nice low, and has been moving up very nicely since. Interestingly enough, if you look at the Fibonacci retracement level of 61.8, after this decline occurred, the market is stopping or pausing right at that Fibonacci ratio area. This area of consolidation lands with that Fibonacci number, and we anticipate that beans could very well give us a nice correction that perhaps finds support somewhere in the neighborhood of 970 to 973. Upon reaching this area, if 973 does hold, we do think that the market can start to make its way back up from there. And in fact, we do believe that upward price progression for soybeans is ahead. In addition to being at the Fibonacci 61.8 retracement, this market also happens to live right at volatility-based resistance overhead. And we can also see that the 180-degree mark sitting at 999 3/4 is also at that level for this market. So we're not surprised at the way in which this market is finding a bit of congestion and having trouble getting much higher than the $10 mark. Once this consolidation or this retracement is completed, however, we do again believe that a very nice run to the upside is possible, and we could see actually soybeans simply staying sideways holding support near the 987 number, which happens to be the point of control for this contract. And in doing so, if it just simply consolidates here and takes back off again, there's not much time left for the March contract itself, but we do believe that the next forward contract could see very nice upward movement to the top side. We can see here where the formation is essentially exactly the same for the July contract itself, with the Fibonacci area coming in at 1014.5. And if you take the next Fibonacci level above at 78.6, that sits at 1028. We can see the market is essentially oscillating between these two Fibonacci numbers. And we can also see that the point of control where support came in for this market is right at 1010 for this contract. One of the possible movements that we can end up seeing for this contract is in the event that we see a bullish consolidation sideways where the market does not fall down too much out of this retracement upon which it's in. We could see a movement then that complements the move that we see coming into that consolidation, repeating itself on the top side, giving us the potential to reach that 1100 mark that we've discussed in the past. From this vantage point, we can see where we met the 1012 to 1014 resistance area we discussed previously last week. And from here, as the market is consolidating near this zone, we can also see that the market is very well inside of volatility-based resistance. Once this market's able to actually break out of this consolidation or whatever correction upon which it's in, we could find some support maybe near our sinusoidal wave here. At this rate, however, we're simply going to wait to see at which point this correction / consolidation completes. And upon doing so, we'll then be looking for our next leg in this market. Back in November and December of last year, we shared that the divergence that we saw inside of the week contract suggested a significant low was due for this market. It put in a very nice low back in December and made a reasonable advance. After that advance, the market actually came back to test a previous low. And we believe that as long as it did not violate that previous low, that another leg up was still available to this market in conjunction with the cycle projections that we were looking at. In doing so, the market has now made a very nice rally and made it all the way up to our minimum price objective of 445. And we can see now that the market is looking to turn over in conjunction with being overbought. This market, we believe, still has some potential legs, and depending on where this pullback or this bit of correction that we're looking at terminates, could make for another nice leg to the upside for wheat. But for now, it has met our price objective for the March contract, and we're simply going to wait to see what else can materialize, given the narrative for this market still suggests that there is quite a bit of inventory out there, and the fact that the U.S. only produces about 7.6 of the global inventory. Much of what goes on for wheat is not dependent on what the U.S. does per se, but very much what happens on a global space. So we need to look at what's going on around the world with wheat to really complement what we're looking at as far as the technicals are concerned. It's nice to see the way in which the 180-degree mark above at 466.25 did hold, and that's going to be our next key level for this market. In the event that we're able to get back above this 180-degree mark, then this market could very well have some very nice legs ahead. As long as it continues to fail below this 466 number, we could go back and retest previous lows, but finding support at that 424 would be very important for this contract as well. Bear in mind there's only about a month left before we hit first notice date for this contract, and we'd be moving forward to the next forward contract itself. Volatility-based resistance overhead has overlaid itself on top. So again, from here, we're looking for the market to maybe come down and give us a bit of a pullback, and perhaps we can find a little bit of support sitting on our sinusoidal wave just above the 360-degree mark of the 424 that we discussed previously. It does bear mentioning that we can see three sets of overlaps where we had previous volatility-based support that has now collapsed, and we have two bands of volatility-based resistance all coming together here. So the side upon which that this market has followed through is going to be very key. If this market's able to break above, again, this 180-degree mark that we discussed before, that tells us that the capacity for continued strength to the upside is still available. And if the market stays below, then we're looking for a retest below. But for now, we're simply waiting to see the way in which the market responds to our current levels before taking any further action. In closing, we'll take a look at the US dollar. And we can see very clearly now that the market has come in and hit our minimum price objective of 89. In doing so, the market now has given us a very nice clean move. For quite some time, we've been discussing that our bias was that the dollar was looking to move to the downside, and it's done just that for us, simply hitting upon the levels that we've been discussing. We can see where the market has consolidated a bit at that 89 price level, and that also happens to be in conjunction with our arc swing measurement. You can see as the market came in, touches that arc swing in conjunction with a projected price parameter, we can see how the market has now stalled a bit. The dollar declining has perhaps helped in the advance of the commodities that we've been looking at, and as long as the dollar continues to decline, we anticipate potential strength in the commodities overall. We can also see on the broader weekly chart, where as the dollar has come in, it's now touching up against very closely to volatility-based support. And we can also see that our projected ABC leg has now been confirmed at a minimum, and depending on the weakness upon which the dollar has, we could see a potential mirroring of the move to the downside back on the other side as well, which simply means that there's continued weakness ahead potentially for the US dollar if it does not find support near this $87 mark. It is possible that we can see a bounce coming up from here before the market does make its way back down again, if that is in fact where the US dollar is headed. But looking at the basket of currencies that's measured against the US dollar and the strength upon which that they're looking to have themselves, the US dollar does look predisposed to continued weakness moving forward for the next couple of months. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next time.